In this video, we'll show exactly how Lemonade can 200 to 300x by 2035 or go bankrupt.
I declare bankruptcy!
But we're going to look at my updated projection model through 2030 and 2035. Key numbers, number of customers, premium per customer, in-force premium, annual dollar retention and churn, expenses, operating margin, and valuation. And also look at Lemonade's cash runway and a bear scenario of failure, how this could fail in the next few years for Lemonade, and really why all eyes are on expenses as CAR rolls out. And if you want to support my channel, you can join my Patreon. There's still a number of the lowest spots open and available. Big advantage of joining the Patreon is you do get access to this model in its entirety, make your own copy, play with the numbers yourself. And as the Lemonade story unfolds, I'll be continually updating and revising this model and presenting it to you guys. Okay, so jumping into the model here, and just to be absolutely clear, there's a lot of factors that can influence a model like this. So one way or the other, this is just a projection, not financial advice. And there's so many assumptions you have to make about what the company could be doing growth-wise, expense-wise, that could have huge impacts on the results. So, and by the way, this is the new base model, but I also did a previous video and I really broke down in detail a previous model. I'm going to try and do a little more high level on this one. So I'm starting here with the red line with where we're at today. We're about 1.5 million customers, just looking at customer growth. Over the next few quarters, I did include when they get Metromile acquisition goes through, I have about 100,000 customers joining there because of that. But then as CAR rolls out, especially as CAR rolls out, I have customers growing at about 41% year over year or 9% quarter over quarter, and pushing that out into the future. Then by 2026, I get to 7% quarter over quarter, which is about 31% year over year growth. And I continue that same growth for the total customers out all the way by into 2030, you're at 20 million customers. And then by 2035, you're at 78 million customers. So massive growth. Some people might think, wow, that's too high a customer growth. If they are successful, I really don't think it is, because the way Lemonade is built, with only being an app, less employees than typical, less brick and mortar shops, it allows them to expand into new countries very easily. And so I don't think, if cash is not a problem for growing, and you'll see in this scenario it becomes not a problem eventually, that I think they could and would grow at a rate something sort of in this ballpark. When I interviewed Daniel on my channel, I asked him if he ever foresaw Lemonade being in Canada, where I live, and he said, well, yes, we do plan to be in Canada. And he said, actually, you could ask me that about any country in the world. I would say yes. Basically every country in the world we plan to be at some point.
I think you'd be hard pressed to name a country and ask me that question and get a different answer. Long term, we see ourselves being as close to global as we can.
Okay, then scrolling back, if we look at their premium per customer, right now we're at about $279. But this is really going to ramp up, I expect it to, as they focus on rolling out Lemonade CAR to existing U.S. customers through their Metromile acquisition. And the way I'm kind of evaluating this is if I look out to, I made a comment here. Yeah, Daniel made comments. I'm going to actually jump over them on Q2. It was Q2 2021 call. He said, as we've said in the past, we think our existing customers are probably spending over $1 billion today on car insurance. So he's talking about the car opportunity at that time. And at that time, they had about 1.2 million customers and about a $1 billion in in-force premium from them, equates to about $833 per customer. So I'm assuming by the end of next year, as CAR rolls out, as more and more people have sort of their terms come to an end and they have a chance to switch, and a lot of people that have Lemonade already with something else decide to bundle it and get Lemonade CAR, I'm assuming 50% of customers have signed up. So that adds about $400 and some of premium per customer. plus what their previous before car base was. So if you think about that, they're at 250 back here before any car, or 279. You add 400. We're in the mid to high $600 premium per customer. Keep pushing that forward, and by 2025, I'm assuming same idea, but 80% of customers who could sign up for car have signed up for car, and you track that out, you're at about $1,100 premium per customer. Then after that rate, I really slow down the amount of premium per customer growth. See, the way I see Lemonade growing is that the top line customers should grow for a very long time at a very high rate, and then the premium per customer should taper off. I'm thinking somewhere in this range as car sort of reach a greater maturation of the customer base. See, the way I see Lemonade growing is that the top line customers should grow for a very long time, just how they're built. And because they could offer also more and more niche insurance products like such as renters insurance, other small things like e-bike insurance, things like that, and little niche products that they could do efficiently, may not be big money makers, but those could be on-ramps for new customers. But all those kind of niche products mean that their premium per customer, I think, will overall stay on an average lower than maybe other insurers might have, just because they're going to have a mix of these other younger, more renters type insurers or customers. So that's why I kind of taper off my premium per customer to 2% per quarter growth and 1%, and then I go down to 0.5%. So it's just growing a little bit, still growing as they expand out products with inflation, as they raise prices, and they push that forward. So by 2030, I'm at, about $1,300 premium per customer, and then 2035, about $1,460 premium per customer. And that gets you in-force premium of $115 billion in that range, the $100 billion range maybe by 2035. And by 2030, you're at 23, 24, 25 billion kind of range. Scroll back here. I'm not going to cover the reinsurance details. I covered that in my other video, but I've left those the same for now. At some point here, kind of see later on, based on their cash runway, they could actually probably by 2030, I could see them taper 2029, 2030 tapering down or lowering their reinsurance. I didn't do that in this model yet, but I might still add in that detail, especially if they are successful or looking successful, then those sort of details will matter more to the future of the model. Gross loss ratio, I have at 90%. Now have it dropping to 80% and then to 75% in the coming quarters, and have kept it there all the way throughout, 75% all the way. Their annual dollar retention. So this is kind of, I think, confusing to people. Some people think this is just your customer churn. It's not. It's actually the amount of premium, say, a customer from the group of customers from 12 months prior had. How much premium did they have 12 months prior, those customers, and now those same group of customers, and some of them probably left the company or canceled their policies. How much premium do they have now? So right now it's at 80-some%. I have it growing to 90% as CAR rolls out. I know in Illinois they said they're about 90% just in that state, just as CAR has just been there for a few quarters now. So I expect it's going to grow even up to 100%. You could technically have ADR over 100% as your premium per customer is growing. But anyways, I have it at 100% as CAR really ramps up and rolls out. And then as their premium per customer, as that drop down, and then I have it dropping down to 90%, 95, 90%, 85%. And I left it at 85%, which means around 15% of customers are going to be churning in the sort of long term. So actually do the math here, it works out to about 17% customer churn, which again, I think should make sense. Right now, they're at a much higher customer churn. They're more like, if we go back here, they're 30-some% customer churn. And in theory, this should drop significantly as more customers get more mature. They have more products bundled together, and they're willing to just sort of set it and forget it for their Lemonade products and not change. but still going to have some growth again because they're growing their customer base so rapidly, and you have more of these sort of niche renter insurer customers that are always going to be there. Okay, and then I project we'll get into expenses here now, sales and marketing. I project my sales and marketing. I project based on the function of new customers that are joining. And I have a cost of acquisition, and this accounts for customers that churned. So it includes the new customers plus customers that churned away. And that gives you, based on historically, what they've spent per customer, and then what I'm expecting going forward. So I'm expecting $200 per customer going forward. And then at some point here, 2026, I dropped to 180, maybe as the company has big enough footprint by 2026. You're talking there at 5.5 million customers. So there's just probably, hopefully, more word of mouth and more traction. And then they can spend less on sales and marketing. Eventually, as a percentage of gross earned premium, I have it eventually getting down to 6%, 5% range over time. It's 40%. It's been in that range right now. It's been way too high. Has to come down, but it should come down as these big ticket GEP, gross earned premium, which is just that's just in-force premium that's turned over to gross earned premium, as that it drops down. Okay, then other insurance expense, I projected this forward. We're at a similar percent of GEP that we're at now, and then eventually getting that down to 3%. This does include things like credit card fees, which I know can be, can be quite expensive, can be even like 2%. So keeping it kind of there down to 3% over time. Include some other fees as well, but that's kind of where I'm putting that at. And then their tech development, they've been in the 10, 12, 13, 21, 18% range. So I have that at 16, 13, 11, dropping as car rolls out. I think they've really been spending and ramping to develop the car. And as that products mature and their customer base expands and grows, and this should drop tremendously, and I have it down to 1%, and then even 0.5%. Then general and administrative, again, we've been in 25 to 30% range of GEP, and I have that tracking in that range as car rolls out, and then hopefully dropping again as GEP really grows as car rolls out. So that's dropping down to 10, 9, 8. All the way down to eventually 6% of your GEP. So get total expenses by 2035, 15%. That's kind of where Geico's at, which is one of the best in class for their expense ratio, so about 15%. Do all that math, you get operating incomes of about 10%, and they're printing about $2.5 billion per quarter by 2035. And again, they actually, during their IPO, they suggested they could get to 13 to 17%. So this might be a little bit conservative, potentially, but maybe more realistic. If it's still amazing if they could get to 10% operating margin here. And you can kind of see it flips to profitability in 2025, but your expenses start to taper down in this model. And they did have said that peak quarterly losses should come. They said later this year. This model, exactly how I have it detailed, it comes, in spring, first Q1, Q2 of next year, and then starts to decline. It really depends how rapidly car rolls out and what their expenses look like, but it's kind of in line with that as it starts to fall. Now, if we look at their cash runway, in this one, I did add in this model, I added back in their stock-based compensation based on, at least for the next few years during this really critical time as they try and become profitable, added back in what they are planning to spend there. And using their cash on hand, I added about $60 million from their Metromile acquisition. Some people did ask me, I want to touch on Metromile, whether their expenses should balloon because of that. Could be, and maybe these expense ratios are going to be even higher in these next couple quarters, really compressed here. That could be. and then drop off. I do think, though, with Metromile, this is an acquisition, not a merger. And my sense is that they're going to take the value they need from the company and gut everything else. So that's sort of why I haven't really pumped up the massive expenses. I mean, the expenses are huge as they are, still are growing, still have them growing here, but not really pushing or pumping them up beyond that. Okay, and so cash on hand though, and then I have here also a cash requirement, which is 1/7 of, based on their reinsurance structuring, is about 1/7 of their in-force premium. So this is how much cash they need to have in order to just to maintain their commitments. That you say you had to pay out there was a disaster, kind of huge disaster, and they had to pay out tons of claims. This is the amount of money they need to keep around. So, and then here's the difference. So if we project that forward, I do have included here a $500 million raise in 2024. I think that will do it. They might do more than that, but I do think it's likely they're going to have to raise money. So you do hope the stock can rally as an investor. Definitely a big risk, and you hope the stock can rally as CAR rolls out over the next year. Now, if I subtract out that $500 or 500 million here, then you can see your difference. You're going to run into problems, major problems, by 2025. And so they're going to need to raise money before that. I'm thinking maybe a year before that, in 2023, 2024. And if you see how that difference grows, you get to about 290 million is the worst, as by this point now they're becoming profitable and the profit's growing. Of course, their in-force premium's still growing, which means your cash requirement is growing, so the difference is still growing. But around here, you have 290 million where it really pivots. So I've added in, I'll just hit undo. I added in that $500 million raise. Then you're clear sailing all the way throughout the model. This is where you could see their reinsurance maybe restructured a little bit around this point in time. But again, going forward into 2030, cash on hand by 2035 potentially could have something like $29 billion. Pulled some taxes out of there, and then I have a little bit of projections on what the market cap could look like. I had PE of 30 in my previous video. I actually have a much higher PE because I think they're not going to be evaluated like a typical insurer if they can still be growing 40% customer base, 30% customer base, and beyond. I think they're going to command a much higher ratio from the market. So if they become profitable, they make it for the next few years, then I have a price to sales ratio of 3. Gets you by 2026. You're in like the $18 to $24 billion range of market cap. So huge upside even in the next few years. And then a market cap, if you go like an 85 PE, which based on their growth gets a PEG ratio of 1.2 to 2, somewhere in that range. This is in the ballpark there. So you're in like maybe $15 to $26 billion market cap. And then you project that forward. I slowly trim down these ratios. By 2030, you could be at 77 billion, 50 to $70 billion market cap, probably in that range. Either way you slice it, you're somewhere there. Projecting that further again to 2035, you're at a lower PEG ratio here, and I'm at a 40 PE, and you're in that like 250 to 320 some billion dollar market cap. So huge, kind of 300x roughly opportunity could be there. And whether you're looking at it that way or this way, you're at maybe 190 to 240, so maybe 2 to 300x into the year 2035 if they are successful, I think is possible. I just want to flip over to a bear market where I just changed a couple things. And the only thing I changed is I said, okay, their customer acquisition is going to be more expensive, $250 a customer. And then I kept that all the way throughout. $250 a customer, especially over the next few years. And then I changed their general and administrative expenses per quarter over quarter changed to 15%. So it stays as a relative GEP. It's still 30, 28, 26, 24, 19. Stays as a much higher percentage, especially for much longer, slowly tapers off, but it's much slower to get there. And then you have certainly more challenges with the stock. And even if you added in your $500 or $500 million raise in Q1, you're still going to have problems, still a growing problem as their in-force premium grows. So, I mean, I'm just showcasing this to show you don't have to change the numbers too dramatically. And if they have poor execution, expenses stay high over the next 2 years, you could have a lot of problems where I think the company could go bankrupt or be acquired for pennies on the dollar, where the investors are just not willing to put up enough money to try and get over the hump. And just because they're not certain they will get over the hump. And if we flip back to the new base model, though, I mean, if you consider, though, so obviously they could go bankrupt, but they also could do a 200-300x in the next, through the 2035 is certainly, I think, a possibility. So that's for me where I'm still tracking it very closely. I will be updating and refining this model again over time, and as the company story unfolds, tracking all of that. So please subscribe if you got value out of this video and you enjoyed it. You can also find me on Twitter at PaperBagInvest. And remember, it's in the bag.